Ladies and gentlemen, a viewer asked me to take a look at Scott's Miracle-Gro company, ticker SMG. Let's see if it can grow us some nice dividends in our portfolio. So, Scott's Miracle-Gro is the company that makes Scott's Miracle-Gro. They have some other products that they make in the lawn and garden category. And basically, all right. So they make Roundup, they make the titular Miracle-Gro, they make some of these other brands that General Hydroponics. So I know they are involved a little bit in the cannabis type area as well, but I don't know all that much about that in terms of the details. Now, something that's interesting about this company is that they do have a negative trailing 12-month EPS. Looks like a loss of over $10 per share in the trailing 12 months. Yet they still do pay out a dividend, which they have grown over the years. However, they have not increased it since 2021. So it has remained flat for the last couple years. And honestly, I wouldn't really want them miracle-growing that dividend with the negative EPS that they've put up lately. Now, looking at their financial statement, particularly the cash flow statement, some things do stand out to me. One is that, at least in the last 3 years, 2022 fiscal year was the first one and only one of the three that had net loss rather than net income, and it was also the only one with negative free cash flow. So both from a net income perspective, they lost money, but they also lost money operationally. Okay, so a couple of outliers stand out as to why this is, and part of it is they had an impairment. So this explains the really bad net income, okay? And they also had, which explains the, to a large degree at least, the negative free cash flow, this extremely big deferred tax bill, which is probably explained by the fact that they had really high net income the previous year. And then, eventually that bill comes due, and they actually ponied up the cash for it after the fact during fiscal 2022. So that would seem to me to explain why those numbers were both so deeply in the red. Not necessarily because Scott's Miracle-Gro is a bad business or anything like that. And on that impairment, there is definitely some more information. So during fiscal 2022, their Hawthorne segment experienced adverse financial results, decreased sales due to higher cost, decreased due to an oversupply of cannabis. So this is that cannabis business segment that we were mentioning earlier. And pre-tax goodwill and intangible asset impairment charges of $632 million. So it seems like it was essentially saying, hey, bad thing happened, and I guess they marked down, in essence, what this business segment that they must have purchased previously was worth, to the tune of over $600 million, hence the negative net income. Something similar happened to Altria when their Juul investment went busto. So to evaluate Scott's Miracle-Gro, we really want to first take a look at what they're doing as of the most recent quarter. Now, what I'm seeing is $1.94 of GAAP EPS, okay, which is not too terribly bad, to be honest with you. Definitely better than negative. GAAP net income of $109.4 million. So it does seem like they are back on the making positive earnings and positive cash flow track. Now, analysts have pretty high expectations for where their growth is going to be in the next 3 to 4 years. They expect fiscal 2023 to be 340, so I loaded that into the DCF calculator. Default discount rate of 10%. Now, to add or not to add the tangible book value, this could really go either way, right? Because they don't really have much in the way of a balance sheet. So, honestly, I wouldn't necessarily... it's not absolutely necessary that you deduct them for the negative tangible book value. So that's going to be dealer's choice. And I think, if we take the very, very aggressive analyst growth rates into account, so for 2024, 25, 26, I'm seeing analyst estimates of like 20% EPS growth in a lot of cases. So over the next 10, though, which is a little harder to predict, and considering the fact that they've had 2 years of negative free cash flow in the last 10 and 1 of really, really bad negative net income, I think we should factor in the possibility that in the next 10 that they may have at least 1 to 2 more, potentially off years during that period of time, and kind of go with a lower number that takes into account the next few years of really, really high growth, but then also accounts for the fact that you may end up with some kind of wonky years in there too, and say, hey, split the difference over the next 10 years. Let's say it averages a 10% growth rate, right? And then after that, something inflation or a little bit higher than inflation, so 4 or 5% thereafter, I think seems somewhat reasonable. And with that, you do come up with a fair value, again, if you don't punish them for their negative tangible book value, of about $60 per share. So this is one where the market probably is more or less pricing this efficiently, or pretty close to it. Because, yeah, if you put in a 9% discount rate, which, some people use a 9% discount rate in these calculations, you come out with almost exactly the stock price with these pretty reasonable assumptions in terms of their growth, right? So I can understand how the market is getting to this, but for me, for a company like Scott's, I might not worry about the tangible book because, heck, we're not buying this thing for the value of their assets. We're buying it for the cash flow it produces, and hypothetically the dividend it pays, the shares it can buy back, etc. I might be more inclined to be interested with something more like a 12% discount rate, because I would want a little more juice for my squeeze, considering how up and down their EPS and cash flow can be year to year. It's a little bit difficult to really predict how steady and they might actually end up being over periods of time greater than the next 2 or 3 years. So considering that, I would really personally be more interested in this, probably closer to like the $50 mark. And hey, honestly, like, we look back just earlier this year in January, and they were at that price. If we look at the last 52 weeks, they were as low as $40 off of that kind of crappy negative net income, negative cash flow result that they were showing out there. So I'm honestly, optimistic that if I were to watch list this at, $50, that we could actually potentially see that if they were to have some kind of really bad off quarter. So, hey, this was a viewer request. I live but to serve, my liege. the Scott's Miracle Grow. If you want to continue being a part of the discussion in an ongoing basis, make sure you subscribe to the channel. Drop your comments below. Let me know what you think about this company or what else you would like to see on the channel. Join the Discord. Link will be in the description. Like it if you liked it. Dislike it if you hated it. I don't care either way. Your engagement feeds me. Take it easy, everyone. Have a wonderful evening.